Carvana, the company that revolutionized the used car business, capitalized exponentially off the COVID-19 pandemic. Carvana allows you to buy or sell your car essentially 100% online, which, during the pandemic, was music to consumers' ears. Additionally, the used car market was booming during the pandemic, and Carvana's revenue was booming as well. However, in 2022, Carvana's situation got extremely dicey, and they were faced with a situation that was unimaginable the year prior: bankruptcy. Faced with overwhelming debt picked up during the pandemic in order to fuel growth, as well as the demand for used cars falling post-pandemic, Carvana's future was uncertain, and the share price fell over 98%. However, like the saying goes, it's never over till it's over. Ernest Garcia, co-founder and CEO, introduced a plan to get Carvana back to profitability and growth, and so far it has been working out perfectly for the company. Carvana reported what it called its best result in company history in the first quarter of 2024, and the stock price has been skyrocketing as a result. So how did Carvana pull off this potential comeback? Let's find out. Carvana was founded in 2012 by Ernest Garcia III, Ryan Keaton, and Ben Houston. The vision for the company was to penetrate the used vehicle market in a unique fashion. Carvana did this by allowing customers to shop for used cars online, as well as creating the first car vending machines. Customers could purchase their cars online based on the inventory in the vending machines, and then arrive at the vending machine to pick up their new used vehicle. The vending machines in reality were a very small part of the company in terms of revenue, but they were extremely marketable and drove lots of interest to the company, as people heard the term car vending machines and immediately were interested in how that would work. The overall online car shopping business model of Carvana was a success, and the company went public on April 28, 2017, with shares closing that day at $11.10. Fast forward a couple years, and the COVID-19 pandemic began raging across the country. In response, Carvana came up with an extremely successful strategy: completely contactless pickup and delivery of vehicles. The customer could use the Carvana app to negotiate a price to buy or sell their used car, and then arrange for a Carvana flatbed truck to arrive at their address to drop off or pick up their used car. Customers enjoyed this unprecedented option for buying and selling used cars, as they were worried about the virus and didn't want to have to leave their house to sell or shop for a car. Additionally, everyone knows how annoying it can be to deal with a used car salesman, so the ability to shop for used cars online and have them delivered directly to your house was an extremely popular option for consumers. As the pandemic raged on, the used car market was absolutely booming, as people were looking for cheaper options for cars, and global lockdowns had nearly halted the supply of new cars. As a result of the booming used car market, as well as the company's contactless delivery and pickup options, Carvana enjoyed unprecedented revenue growth. In the first 6 months of 2021, Carvana sold a record 200,272 vehicles, and for 2021 as a whole, revenue topped $12.8 billion, a 129% increase from the year before in 2020. The company's stock skyrocketed as well, reaching $360 in August 2021, a 3,152% increase from its IPO price. In order to keep up with demand, Carvana continuously bought massive amounts of used cars, as they didn't want to run out of inventory while their business was doing so well. Unfortunately for them, this would prove to be a near-fatal move. In 2022, as the pandemic subsided, interest rates began rapidly rising, and used car prices began to plummet. Carvana was now in a very sticky situation, as they had just bought tons of cars at premium prices, yet those same cars were now selling for way less than what they had paid for them. Consumers were also spending less in general due to the soaring inflation, so Carvana's outlook began to look extremely grim. The problem wasn't only that demand and sales were greatly slowing, but Carvana also had a major issue with debt. Throughout the pandemic, Carvana had to borrow massive amounts of capital in order to keep up with their exponential growth. At the end of the third quarter of 2022, Carvana had total liabilities of over $9.2 billion, with only roughly $600 million cash on hand. Simply put, Carvana had to repay lots of money, but they barely had any money. And they weren't expecting a massive influx of cash anytime soon, as their car buying and selling business was obviously doing very poorly due to the macroeconomic factors. Carvana was officially on the brink of bankruptcy. Perhaps the most telling sign of this was the yields on their corporate notes rising to over 30%. As an investor, this is an extremely worrying sign because it shows the extreme desperation for cash that the company is experiencing. And the market responded accordingly, with Carvana's share price falling to just over $4 towards the end of 2022, a 98% decrease from the all-time high just a year prior. Even though the situation for Carvana had never looked more grim, the company did not give up. In 2023, Garcia introduced a 3-step restructuring plan that he believed would pivot the company in a positive direction. Step 1 was to drive the business to break even. Step 2 was to drive the business to significant positive unit economics, for example, positive free cash flow. And finally, step 3 was to return to growth. Over the last year and a half or so, Carvana had completely restructured their operations in an attempt to fulfill this 3-step plan. The company shifted their mindset from growth, which had been their mindset ever since their IPO in 2017, to cost-cutting. At the core of the company's restructuring and cost-cutting is everyone's new favorite thing, AI, or artificial intelligence. Carvana introduced Carly, which is a software AI platform that helps in the processing of vehicles that pass through Carvana's reconditioning process. Carly helps record inspection data, pricing data, costs for various parts needed for each car, and more for all cars that Carvana processes. Additionally, Carvana has introduced other AI systems that will subsequently assess market value and pricing for each vehicle. As of February 2024, Carly and these other AI systems have contributed to $900 in cost savings per vehicle over the past 12 months. Other AI software that Carvana has introduced include custom tools that support logistics activities. These tools optimize mapping, routing, driver scheduling management, and pickup and drop-off window availability, leading to savings of over $200 per unit. Finally, the last significant AI software that Carvana has introduced is the most obvious use of AI by companies: AI customer service software. Carvana used generative AI to optimize customer support chats and calls. This generative AI that Carvana uses reduces manual labor, as well as reduces errors that a human support person might make. For example, a human support person may accidentally schedule a pickup or drop-off time at the wrong time or on the wrong day. AI will not make this mistake. Carly and the other AI systems that replaced processes that were previously manually done by Carvana employees contributed to the total Carvana employee count being reduced by over 4,000 people. This massive drop in employee headcount, as well as various other cost-cutting measures that the company took, led to over $1.1 billion of annual expenses being eliminated. Another significant measure Carvana took was successfully restructuring its overwhelming debt. In July 2023, Carvana announced they pushed back the maturity of 83% of their 2025 and 2027 bonds, and lowered their yearly interest expense on those bonds by over $430 million over the next 2 years. All in all, this represented a total decrease in over $1.2 billion in the company's outstanding debt. Pretty impressive. This significant improvement in cost-cutting, as well as the massive debt restructuring, has been received extremely well by the market. At the beginning of 2024, Carvana stock sat at just under $50, over 10 times the price of the stock's all-time low of just above $4 in 2022. And as 2024 has gone on, the situation has continually gotten better for Carvana. In May 2024, the company reported revenue of $3.06 billion, compared to the expected figure of $2.67 billion. Not only that, but the company reported a net profit during the quarter of $47 million, compared to a $286 million loss during the same period a year prior. In the first quarter, we delivered our best results in company history, validating our long-held belief that Carvana's online retail model can drive industry-leading profitability while delivering industry-leading customer experiences, said Garcia in May 2024. Garcia attributed the company's positive performance to the increased efficiency of its operations, which were driven by the AI systems that simplified Carvana's vehicle reconditioning process and significantly reduced costs. The company's stock now sits at $117 at the time of recording, a whopping 139% increase year-to-date, and a staggering 910% increase from the same point just a year ago. Additionally, if you had invested in the company at its all-time low of just over $4, today you would be up over 2,800%. This is still a long way away from the company's all-time high of roughly $360 during the pandemic. However, it's still an extremely promising sign for Carvana. Looking back at Garcia's three-step plan, it seems that he has potentially completed the first two steps. Free cash flow for Carvana was finally positive in 2023, as the company brought in $716 million, compared to losses of $1.86 billion and $3.1 billion in 2022 and 2021 respectively. Most likely, Garcia will not immediately jump to step 3 of his restructuring plan, as it would be smart to further solidify the positive gains that the company has made and continue to bring in massive amounts of cash. However, like I said previously, this is all extremely promising for Carvana. Looking into the future, Garcia says that Carvana looks to continue increasing profit margins in the vehicle reconditioning department, as well as rebuild its vehicle inventory, which was dangerously low early on in 2024. In the shareholder letter for Q1 of 2024, the company reported that it expected another year-over-year increase in profit and revenue for Q2. Are you a believer in Carvana? Do you think they'll be able to continue defying the odds and profit each quarter after facing bankruptcy in 2022? Let me know in the comments, and don't forget to like the video if you enjoyed and subscribe for more business and finance videos.